Hello everyone and welcome back to another episode. Right here we have my performance in 2022 and then my performance versus the major indexes so far year to date in 2023 as of July 1st. It's been a couple months since we made this update, but I'm going to show you exactly how I've got this performance in the stocks I'm currently holding. Now you may be wondering, why exactly do I have call options in GameStop? This doesn't fit the theme of the rest of the portfolio. And you're right, this is not something I'm going to bet a massive amount of money in. Just a couple $1,000 just for fun. Right now we have about $3,900, and you can see that it's mostly based on the release of this movie coming out in September. Now once again, this is very stupid. This is a very big gamble, and it is not something that I'm relying on making big money. But I think that there's a lot of opportunities for a lot of excitement to build up for this movie, and especially GameStop stock, early, mid, late September, and maybe even going into October, and I bought my call options that expire in October. It's a complete gamble. If we lose the money, if it goes to zero, which it very well could, then it's no problem. I still have 96% of my money invested in other things. Now let's go ahead and go to the position higher than that. Obviously, that's the little baby position in GameStop. Above that, we have PayPal, right at almost $20,000 exactly invested in this company. Now let's go ahead and load up PayPal stock. And I forgot to mention, while I'm getting this loaded up, if you want a referral bonus, go ahead and use my referral link down below for M1 Finance if you're interested, so that way you can get a free up to $100 for getting signed up. Now PayPal, this is one that I think is really interesting. Okay, here we go. I finally got it pulled up. This is PayPal's fundamentals. Looking at a company like this, you can see that they have growing revenue, they have growing EBITDA, cash flow, net income, EPS. Generally speaking, everything is going in the way that you want it to. Now, the funny thing is, if you look at the stock price over the last 5 years, it's actually down 22% over the last half decade. Over the last decade, it's not even up 100%, only 80%. Most of these big losses have come from the peak back in late 2021, almost exactly 2 years ago from today. Now this stock actually broke $300 2 years ago, and today you can buy shares in the 60s. Right now it's currently $66, and my average share price that I bought at currently sits at $65.87. So I just bought into this. You can see I just bought my shares a couple weeks ago, anywhere from $6.9 up to $6.30, and you can see most of my shares are pretty much break even since it's so new. Now basically I have a pretty easy, simple, fundamental basis for why I'm buying this company. The company, I think, will continue to grow revenue. I think they'll continue to grow free cash flow, and I think especially this year their earnings per share is going to go up quite dramatically, because I think they're going to start buying shares in a much bigger way. Now they've been buying back around 2% or so of the stock every single year, as you can see from the numbers down here, but I think that's going to ramp up big, because they did just get $1.5 billion for selling their buy now pay later services. And more importantly, the stock is trading at rock bottom valuations. So let's go back to this 5-year chart here. If they're buying back shares around $150, $200, $250 a share, it's very hard for them to buy back a lot of the company. But if they're buying back shares at $100, $75, or even where the stock has been lately, around $50, $60, they can buy back a higher percentage of the company for the exact same amount of money. So rather than buying back 2%, 3%, they can buy back maybe 4 or 5, maybe even a best case scenario, maybe even up towards of 6% if the stock stays down low around these levels. So as the company gets better and better in valuation and the price goes lower and lower, it becomes more attractive to me as an investor. And over the last year, this is pretty much the lowest you can buy it at. I think the absolute low is like $59, $58, but right now I think is a pretty good deal, and it's not one that I'm willing to make my large position. I won't grow this into, say, a $30, $40, $50,000 position. 300 shares is pretty much where I'm capped out at, and I'll probably start selling my initial shares of my 300, probably around $80, $90, $100. I'll start slowly trickling away shares and probably sell completely out around maybe, say, $100 or so. Now next we have another new position as well, also started in June and July, and I just bought more shares of this just the other day, and you can see that right now Crocs trades at 112. Now my big winner so far this year was Crocs, selling out $13,000. And if you've been following the channel, you should know that this is one that I have owned all throughout pretty much all of 2023, with one exception. I initially bought my shares at around $76 during this price range in late 2022. Now when I bought those at $76, I held them all the way through the run-up and ended up selling right here during this big earnings peak. It actually went slightly slightly higher than what this chart is showing. I sold at 142. So we basically doubled up our money in about 6 months or so with Crocs, and selling my shares at 140 were nice, and now I get to buy them right back 200 shares more at an average price of 108. So I got to buy the shares well over $30 below where I initially sold them, and now we're back in the green a little tiny bit. We just opened up this position. The theory with Crocs is simple. Basically, we've had Google Trends going through the roof for stuff like Hey Dudes, like their main brand, and of course the Crocs brand as well. Now, if you look at Crocs brand, it hasn't seen the uproar that I'd like it to see on Google Trends. And let's go ahead and look over the past, let's say 3 years. So let's put in a custom time range. Let's put 0, 1, 0, 1. Let's go through 2020, and we'll go all the way up to today's date. Now you can see Crocs is on a pretty decent uptrend. It's not at record levels, but it's on the higher end of the range over the last couple of years. Now let's go ahead and do this up to 2021 so we can probably get more up-to-date data, a little easier to see. You can see that generally speaking, it's on the higher end of the range. Now same thing here, but I want to look at Hey Dude. Let's see how Hey Dude has been doing. Now you can see it's basically, other than Black Friday last year, at all-time highs. Now generally speaking, during this summertime, around June, July, where it was last year was around probably 45, the average here, late June, early July. And if you go back to the year before that, late June, early July was around 30. So it's been uptrending, and as of late, we've had a big summer boom, and I think we could see that reflected in sales. Now obviously, I'm not going to base an entire investing thesis just off of Google Trends, obviously, but generally speaking, this is a company that has one major risk, and it's this big, nasty, red-looking line right here. Let's go ahead and zoom in so you can look at it better. You see this big, nasty red line, which is their long-term debt? This is when they bought out the company Hey Dude. $2.8 billion was the amount of debt that this company had and long-term outstanding debt. Now, just in 1 year, they've reduced that debt from $2.8 billion all the way down to $2.2 billion. That's a pretty big downturn in their long-term debt, buying back $600 million worth of their debt that they had to pay to buy out this company. And then, of course, this is while the company has seen a massive influx in increasing revenues, obviously from that acquisition. They have exploded. The free cash flow is starting to hit record numbers with last quarter far outpacing any record they had set before that. Before that, the highest they had ever seen in record free cash flow was around $200 million or so, and now they almost doubled that at $340 million. Now I expect the free cash flow to be a lot higher. I expect this debt, the big major scary thing with this company, to slowly go away over time, and I think this $2.2 billion a year from now is probably going to be like $1.5 billion if I were to guess. Now we'll see, but overall this is a company that trades cheap. Forward PE on this sits around 8.86, and it's one that I think will generally do okay because the low expectations are already baked into this company. Now I'm selling options, as you can see, like always on this company, like all four of these actually, where I'm continually generating income just for holding them. But you can see that generally speaking, I'm selling shorter term options so I can hold these companies for the long term. Next up, let's go ahead and take a look at Amazon, AMZN. And I won't talk about this one too thoroughly because I've mentioned it so many times on the channel, and I've talked about it so much for the last year now. Like I said, I've been an owner for, let's see, probably around 1.5 years now, but generally speaking, the thesis with Amazon is sound. This free cash flow number of negative $9 billion, and including the ones over here, like -6, -5, -17 free cash flow. That is just numbers that is not going to stay with this company. If anything, I think it's going to be completely flipped on the opposite, where these record levels of 14, 13, 15 billion of free cash flow is about to flip into the positive very hard this and especially next year once they get their affairs in order. Now they spent a lot of cash and they burned through a lot of that cash trying to get this company flipped back around, paying severance packages. They overspent on warehouses and a lot of R&D spending. But overall, Amazon has all the businesses growing in the right way that I need it to, with its advertising business, with AWS, with third-party seller services, all the sectors that are profitable, not their old school e-commerce business, but all the sectors that I care about are mostly generally across the board still growing double digits between 10 and 15%. Now that's what I want to see, especially for a time when the economy is a little bit slowing down and it's harder for people to want to spend money. When Amazon is still doing that great, it's one that I want to hold. Now it's not as attractive as it was just the other day when I was buying it. When I doubled down and I bought another 100 shares in my position, you can see, what did I buy those at? I think it was 83. Yeah, right here. I bought more shares of the company at $83 and really got bullish on the company, and now it trades at 130. So you can see it is 56% higher from where I initially bought it at. So right now is not where I want to be buying Amazon, but it's also not the position where I want to be selling it. Right now it's pretty much a hold. I'll continue to sell covered calls like I do down here, and I'll just kind of wait to see what happens. If it goes higher, I'll start to trickle away and sell some of my shares, and if it goes a lot lower, who knows, I could end up increasing my position from 200 shares to maybe 300 or 400 depending on how low it goes. And then pretty much the same thing for Dropbox here. We've had a big run up. If we go ahead and pull up Qualtrim here and then pull up ticker symbol DBX, Dropbox has exploded. And if you look over the last 5 years, it's been stuck in this range right between $20 and $25. And we finally got an average share price of this company right at 20.77. And so far, the company has went pretty much straight up. You can see right now the company has recovered quite significantly, and today, just yesterday, it broke $27. It closed at $26.97, but it broke $27 earlier in the day. And this company just has steady revenue growth quarter after quarter. Based on every product and based on the geographies and they sell at, everything across the board is clicking in the right direction, and free cash flow is also trending in the right direction as well. Now, like PayPal with this company buying back shares, they're not buying back 2%, 3%, 4% of the company's shares. They're buying back right around 5%, and it's actually about to go up because they're increasing buybacks. So with this company, just say, let's look at this. 3 years ago, they had 420 million shares outstanding. And in 3 years, they've decreased that from 420 million all the way down to 348. They're buying back lots and lots of shares, so you're owning more and more of the company without actually putting more money in. So that's what I like to see. With this company running up so much in share price, you might think it's overvalued, but actually the forward PE only trades at about a 13. Now that's not wildly, insanely cheap, but when I started buying this company initially, it was at a PE, forward PE, at around 8 to 9. That's very, very cheap, especially for a high margin, high profitable business that is growing consistently quarter after quarter after quarter. Now 13 is not an absolute steal deal. It's not rock bottom prices. And similar to Amazon, if I want to buy more, it's going to have to go back down. I did sell some of my shares like I showed just a little bit ago. I did take some profits, small profits of only $1,200, nothing massive. But since I did get to sell some of my shares, it now frees up some capital. If it goes down, I get to buy more. And if it goes up, well, I'll just keep on selling for profit and rotate it back into other stocks. But right now we're doing great. I think that this portfolio is doing well above my goals, and you know that you've been following me. I'm trying to get to $1 million by my 40th birthday right here by February 5th of 2039. And right now this is my month by month in 2023, and then my year-over-year goals for the next 20 years. Now we need to have 61,000 by February of next year, over the next 6 months or so. And so far we're on track to do it because we're ahead of pace. And so if I can finish out the year strong, then we'll be doing just fine and we'll be right in time for my goals. So if a couple of these positions, like for example, honestly, since I'm still making deposits consistently at $500 a month, even if all of these positions stayed the exact same value they are today, I would still be right in line for my goal for where we'll be at 6 months from now. So honestly, if we can have these stocks hold still and especially go higher, like maybe my gamble of GameStop turning out, or especially my lower performing stocks like Crocs and PayPal perform better over these next 6 months, then I think it could really propel my portfolio into the $60, $70, maybe even $80,000 range over these next 6 months to a year or so. So thank you guys so much for watching. I appreciate you staying all the way to the end. Check out M1 Finance for that free referral link if you're interested. But other than that, guys, that's all, and I'll catch you all next time.